All right, we are going to have some fun with this video. We are going to look at designing policies for maximum cash value, and we are going to specifically break down a one-year term insurance rider and see which design is truly in your best interest when your goal is to maximize the cash value of a life insurance policy. So what we are going to look at specifically in this video is the same policy on one individual. We're going to look at a 40-year-old individual funding a policy with $100,000 initially. You'll see that he will drop the funding. We're going to go through the funding. But what we're going to look at here is first a 10/90 split with a one-year term rider. So what a 10/90 split represents is if he's paying in $100,000 per year, 10% or $10,000 is directed toward the base premium. Base premium dollars do not show up in cash value in the first year. In this particular example with this product, beginning the second year, base premiums do come back to cash value. So I've got 10% that does not show up in cash value initially, in addition to the term rider cost, PUA fees. But the biggest chunk of expenses, if we want to think of it that way, is minimized as we've reduced it to 10%. A one-year term rider. How this works. A term insurance rider is beneficial to a whole life insurance policy because it is a cheap, if you don't like the word cheap, a cost-effective way to add more death benefit. And the death benefit has a direct relationship to the MEC limit on a life insurance policy. Remember the core benefits to a cash value life insurance product: safe, liquid, tax-free. If the policy becomes classified as a MEC, a modified endowment contract, the tax benefits are out the window. So a one-year term rider is a means to raise the death benefit, which raises the MEC limit. And why it has the verbiage one-year term rider is because each year, as one grows older, the actual cost for that term insurance increases year over year. As I grow older, the internal costs increase. However, what you will find as we examine this rider, and you'll see this with just about every company that offers this rider, is as you add money to the policy, as dividends are paid to the policy, your whole life death benefit increases along with your cash value. As your whole life death benefit increases, the term amount decreases, which often results in your net costs coming down. And we'll model exactly how that works. We'll have some fun. We're going to reference illustrations and a whole lot more. So we're going to look at a policy, minimum premium, 10% premium with a one-year term rider, and then a 40/60 split without a term rider. With this particular product, 40% was just about as low as we could go. We could put a little bit lower, but we wanted a round number in this example. We're going to look at one of my favorite policies, a Guardian L95 policy. I'll refer to this sometimes as a hybrid policy. Why I do that is long-term, this doesn't give up too much cash value in terms of performance. But when I look at the worst part about a whole life insurance policy, the first and second year, those base premium dollars don't show up in cash value. With the L95, it's only the first year. And I can continue to feed the policy for a prolonged period of time if I want to or not. So the funding, specifically what we will look at here. We've got $100,000 per year going into the policy for 10 years. At that point, the individual can choose to stop with either the 10/90 or the 40/60, no problem. But instead, what we're going to model is funding continuously being paid in. So he's going to keep making payments of $40,000 per year forever, up until age 95, as long as the policy will allow for it. So this is meant to demonstrate, does it make sense to go with a 10/90 split, which will give you more cash value up front? Will it give you more money long term, both on a non-guaranteed basis and also a guaranteed basis when we look at the same company, same product, same individual, health rating, everything apples to apples, keeping it a fair comparison. So what we'll see here is with a 10/90 split, from a year 11 onward, we have a $10,000 base premium. So if you're going to pay $40K per year, that means everything above the $10K, the other $30,000, is constantly added to PUAs in this example. And then with the 40/60 split, beginning year 11, the full $40,000 is just the base premium. What that also means, from a flexibility standpoint, is from year 11, you can do this really from year 1, but year 1 really, my base premium is $10,000 with the 10/90 split. I can literally commit to that and add additional funds at discretion. in the event life happens and I need or want more flexibility, where I'm not committed to this large dollar amount, but a minimal amount and can add more toward the PUAs and grow the cash value at discretion, I can do that with a lower premium product. So what we'll look at here is the direct impact these two different designs have on your cash value, the agent's compensation, and we will break down the 1-year term cost as well, so we've got full transparency and we can see some real numbers. Let's have some fun. Before I just jump into the numbers here, actually, wrong spreadsheet, there we go. Let's take a look at the full illustrations, shall we? So we will begin with the 40-60 split, and we have both the guaranteed and non-guaranteed values in this particular case. What you'll see, upper right-hand corner, base premium, $40,000. Paid up additions rider in blue, that's my PUA rider, $60,000. There's my 40-60 split. Of the base premium, just about nothing shows up in cash value in the first year. I'll show you the exact dollar amount shortly. You'll see guaranteed and non-guaranteed. I've got about $56,000, almost $57,000 that shows up in cash value immediately. With PUA riders, there are fees. So I will never see the full $60,000 show up in cash value with just about every company out there. Not in the first year, at least. Once compounding kicks in, it gets better and better. The dividends and interest earned on the policy will somewhat mask the additional costs, if that makes sense. Let's continue on here. I said I was going to show you the exact costs, or the exact percentage of that base premium that shows up in cash value in the first year. Because if I'm you, I would want to know that. There's the $40,000 base premium. That buys you a whole life death benefit, $2,050,000, which for a 40-year-old male gives you, to be precise, a $101,000 MEC limit. So just about the minimum death benefit needed to pump in $100K per year. And then here we go, base policy premium, cash value in the first year, based on your base premium only. So the 40K premium gives you $1,400 in cash value in year one. You've got a total payment of $100K, and your net cash value is about $57,000. It's a big hit right off the bat. As we look at this over time, what do you notice here? After year 10, what do you notice? Your funding drops to $40,000. Why we did that, by the way, is a policy without a term rider like this, if we want to keep feeding it at $100K per year, it'll MEC. We're forced to reduce our payments with this particular company and design. If we like a 1090 split or any type of split with a long funding period where we can keep pumping money in PUAs at the max level, we've got some other content on that. I would check out our how long can I fund a policy with a 1090 split. So here, we dropped the PUA rider after 10 years, paid in just $40K per year. There's your cash value. Break-even point in this particular example, between year 7 and 8. Year 7, you've paid in $700,000. You've got $695. 40-60 split. Really not that bad when we look at it. And with an L95 policy where they're only overcharging me in the first year, that's where I see a little bit earlier break-even point. The traditional product, that'll be delayed closer to years 8 to 10, depending on how much I'm funding and such and what I look at. But that's my 40-60. Let's look at the 1090 split. We're going to have some fun with this one. So here we go. Where's the money going? 10K base premium buys me a whole life death benefit of just over $500,000. If I stop there, that gives me a MEC limit for this particular individual in this case, just over $20,000. I'm sorry, just over $25,000. Term insurance rider. $4.2 million. Large term rider. We can fund $100K per year much longer than the 10 years I'm going to show you with this. But funded it for 10 years. There's the first year cost. Keep that exact dollar amount in mind. You can jot it down too. I'll show you, you'll see why as we progress through this. $1,575.78. That's the 1-year term insurance rider cost for year 1 only. Now, as we progress down, Here we go. Guaranteed values on the left. My guaranteed values. There's my non-guaranteed values. I'm positive between years 5 and 6 in this particular example. Let's go down to the ledger statement. Breakdown where the money's going, same as we had before. The difference you'll see is on the far left. Your base premium is $10,000, not $40,000. Look at this from a ratio standpoint. How much shows up in cash value right off the bat from the base premium alone? Not that much. Now, net premium, net after-tax outlay, these are the same, $100K per year for 10 years, and then $40K per year thereafter. So what this means here is you've got your $10,000 premium payment, you're paying that, and then adding an additional $30K per year into PUAs, add the two together, that's where we come up with the $40,000. Paid all the way up until age 95. There's the total cash value over time. And we can scroll down as far as we'd like, and you'll see all of these exact values on Excel, because we're just going to export everything there and make it a lot easier as we compare and contrast with both the 4060 and the 1090. Now, let's take a look here. Term cost. If you're subscribed to ILS Agent Academy or training business, we actually will go through how to actually break these costs down, how to generate them in the illustration, and then turn these into actual dollar figures that are 100% accurate to provide transparency to your client. So this gives us the cost for every $1,000 of term insurance that is attached to the policy. So on the right, see that column where it reads face amount, 1 year term? In fact, the term rider, before you pay anything into it, is about $4.2 million. At the end of the first year, it's $3.9 million. The reason why is as you add money into PUAs, your whole life death benefit goes up, which was initially $500,000. As that keeps going up, the term rider comes down each year. And the two will always be level, or always equal the level death benefit of $4.7 million, or wherever we set it, until it A, naturally expires, or B, we chop it off, which we can chop it off anytime after the 7th year, typically to avoid a MEC. And then we can also partially reduce it, sometimes before the 7th year. Depends on how much we paid in and what our total MEC limit was. But in this example, we're going to remove it all together after year 10 and keep the funding apples to apples when we compare it to the 4060. And if you want to see different funding scenarios, let us know. And if we can do it, we will. If we won't, we will let you know the limitations. So keep in mind of these, we've got the current charges and then also the guaranteed maximum. Very unlikely here, but we are going to look at both. So beginning with the dividend values. Beginning with the dividend values. On the left, what do we have? 40-60 split. Identical values to the illustration we just saw. On the illustration, I didn't pay much attention to this column. I do have it on here for a reason. You'll see why. Year 1, 100K goes in. You've got almost $57,000 in cash value. Year 2, you pay in $100,000. You're at 56 and change. It grows to 157 and change, meaning you get your $100,000 back and a little bit more on top of it. This is that L95 product. This is meant to demonstrate that they're only overcharging for the base premium, heavily overcharging in the first year, because the base premium of 40 is consistent each year. Next year, paying 100 again, a little bit different effect, where I don't get all of it back, and then I get more, and it picks up the pace, breaking even between years 7 and 8. Example on the right, 1090 split. $10,000 base premium, 100K total, first year cash value, just about 82%. If we were planning on stopping funding after 10 years or paying in just the base premium thereafter, I'd really shrink this term rider a lot more, and you'd see a little bit more cash value right out of the gates. But here, we wanted to illustrate funding forever, so I had to overinflate the term rider quite a bit to prevent the MEC from occurring. If you start out with a level death benefit, when the MEC test resets after the first 7 years, if my death benefit's still level, you're going to see a lower death benefit there. I mean, lower MEC limit is what I meant to say. Here we go. After 10 years, 40K. Example on the left, after 10 years, 40K. What do you notice about the dividends in these two examples? When we look at the actual dividend columns, take year 2, for instance. Dividend payout is higher, but what's your cash value? Big difference there. Over $20,000, over a $20,000 difference. You're at 179 and change compared to 157 over here. If we look at year 5, you're at $15,000 dividend, whereas over here you're at 11, just under 12,000. Yet you've got almost $40,000 more in cash value. So the reason why has to do with how dividends are applied to policies. The actual dividend formula with most insurance carriers, when it's applied to base premium dollars and PUA payments, is more favorable to base premium dollars. When you actually look at the definition of paid up additions, each PUA payment functions as its own individual whole life insurance policy and receives a separate dividend. So that's why they're different. I know that's technical. I'm talking actuarial stuff now, but that's partially the reason why. In any event, the dividend shows the total dividend that's paid to you as a policyholder, but I'm interested in this column, the net cash value. What does that look like? Now, before we scroll down and look at the comparison, we've got a massive term rider attached. What's the actual cost here? Let's take a look. So what we're going to do is pull the actual term cost from this illustration. So if we go back, so what do we have the first year? 3939. Year 10, 1660. Let's go back to the illustration we had up just to make sure everything's valid here. Okay, there we go. There's the cost for every $1,000 of term insurance. So as an example, year 1, for every $1,000 of term insurance, it costs 40 cents for this 40-year-old individual. So what we want to do, just multiply it by that per $1,000, and there's the cost. A way you can check this, look at the illustration. What's the first year term cost? $1575.78. $1575.78 to the penny. There we go. You'll notice it doesn't cost anything after year 10. As we drop the term rider, you'll see the net death benefit drop there as well. There's your actual cost each year. So what that means, of your 100K, 10,000 went toward the base. Call it $1,600 went toward the term insurance rider. The first and second year, it's guaranteed not to increase. Then it begins to increase each year. This is with Guardian. That does not occur with all carriers. Some increase at beginning year 2. But it increases. My term comes up a little bit and then starts to shrink. If I kept the term rider on and kept on plowing in 100K per year, I would see it continuously shrink each year. But here we cut it all together. And if we really wanted to optimize it, I would start it out about $1 million less. But then that would force me to stop funding 40K per year. I'd have to reduce my funding if I wanted to pay into it until my 90s. So let's take a look here. This is based on the present dividend rate of 5.65%. Let's take a look. Let's look at age 75, shall we? Which one do you see more money in? $40.60, 5270, 1090, 5458. Same company, same product, same health rating. Everything's apples to apples, pulled directly from the illustration like we always do. What else do we see? If we go all the way to age 90, if we really want to look at it long term, what do we notice here? It's about a $300,000 difference in favor of the 1090 split. Exact same dollar amount is paid out of pocket each year. Now, from our prior videos, you know that some products we can model a higher base premium actually displays stronger long-term values, but will that actually happen? We see that the product's very important. Let's look at the guarantees. So, no dividends because we're looking at a worst case scenario, just the guarantees in this particular example. Same thing, 100K for 10 years. By year 10, what do you see? About a $40,000 difference. 4060 has 911, 1090 has 956. If we look at this before we look at it long term, let's look at the term cost. There we go. So same thing, there's the 3939, 1660. Pulled this directly from the illustration. If you want to look at it again, I always like to triple check this stuff to make sure everything is accurate. Okay, there we go. Perfect. Term cost. You'll notice that guaranteed rate is higher, so the cost goes up. Does that mean I should be worried? Here's what I would look at. Net cash value, side by side. Would you rather have a higher term cost here in the event rates go up, which are extremely rare, but say they do? Would you rather have that higher term cost still with a $10,000 base premium? Or would you rather have a $40,000 base premium? Even if it's a $25,000, 25% base premium. The base premium is still higher, and that's what's going to cause drag on the policy, specifically when we look at the long-term comparison. We can go as far as we want. Not going to make a difference. Year 50. It's about an $800,000 difference, and this is based on the guarantees. If we go back to the non-guarantees, wasn't quite as much. What was it, $400,000 or $500,000? But a big, big difference there. So when the goal is to maximize the overall cash value, a one-year term rider allows two things. One, it's a term rider, so it boosts your MEC limit and allows you to add more into PUAs. But two, it provides maximum flexibility, where a company will allow you to throw additional funds into PUAs. Here's the reason why. The 4060 over here, we don't have a term rider attached. So what that means, this company won't even allow you to add 10x the base premium. The first year they will, they'll let you go up to 50x, and that's with both models. But beginning year 2, the most the company will allow policyholder to add is 3x the base premium in PUA payments without medical underwriting. If you have a one-year term rider attached, they'll allow us to continuously illustrate 10x the base premium in PUAs. The reason why is when I'm dumping a large amount of money into PUAs, that does buy me more whole life death benefit. However, if I have a one-year term rider attached, the term rider just decreases and the net death benefit stays the same. You can see that if we go back to the full illustration. We go up a couple pages. Here we go. So we can see it right here, where that term rider is going down. In fact, I got to do this a little bit differently just to properly demonstrate this. Interesting stuff, right? We've got a cash value life insurance policy here. Typically, when we hear the word life insurance, we think, I die, money gets paid out to my beneficiaries, and then we start getting creative with all this extra stuff. But it's a lot of fun. Like when you really understand how the mechanics work, you can do a lot of damage in a good way. There's your whole life death benefit, day 1, day 0, I should say. There's your term rider. So as you add money, particularly into this component, which is your paid up additions rider, this column, cash value of all adds, I like to think of as money I add to cash value, because when I add PUAs, I see my cash value immediately impacted in a positive manner. That's just how I like to think of it, cash value of all adds. This column represents PUA payments and also dividends that are kicked back into cash value. All cash value added through PUA payments and dividend additions. Dividends kicked back into cash value. The column immediately to the right of it, total face amount of adds, represents how much additional whole life death benefit is purchased from your PUA payment. So you made a PUA payment. Portion of that went toward the term cost. Just under $82,000 showed up in cash value from the PUA payment. That purchased you as a 40-year-old male, very healthy, another $250,000 in whole life death benefit. That $250,000 in whole life death benefit was added to $510,000 of the original whole life death benefit, and the term rider, which was initially about 4.19, subtract that by 251, and it gives you the 3.93. The whole life plus the term will always equal that total death benefit. Man, that was a lot of info. Point is, when you've got that 1-year term rider attached, an insurance company is much more comfortable when you dump a ton of money into PUAs because the net death benefit doesn't increase. It does not add an additional liability to their books. That's why they don't require medical underwriting. This is why a lot of corporations utilize this rider when we look at executive benefit planning and such, because it juices the cash value. But it juices the cash value. Why the companies can continue to pump a lot of money into it is because there's not added risk to the insurance company until the term rider burns out or naturally expires. So to wrap this up, if we look at the compensation here, here's the difference. Higher base premium equates to what? Higher compensation. It's based on our payout rate in the industry right now for full transparency with this particular insurance company, which compared to other carriers, we'll say they pay the least, but they deliver when we look at their actual results. That's why we use them. It's not about how much we make. Do the right thing and the money will come, right? So 40-60 split, higher base premium, $72,000, almost $73,000 total. The first year, $36,000. Over here, the 10-90 split, $11,400. In the first year, total $42K and change. I'll add, if this was a smaller company that does not solicit business in the state of New York, this would be much higher, where that base premium will have a compensation rate anywhere between 130 and 150% in the first year. But we don't need to get into that. That's just how compensation works, though, when you really break it down with different companies and products. A lot of info there. I hope that this video was helpful. If it was, please hit the like button, subscribe. Feel free to leave a comment below. If you have any questions, you can leave them in the comments, or you can email us direct, give us a call. We're always happy to help and talk life insurance. As always, I hope this helps. Thanks so much for watching. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.